guys, welcome to another new strategy learning session in the Nifty BN channel. Today we are going to talk about Nifty wheel. We are going to talk about the wheel strategy where we can do it in Nifty. And the Nifty wheel strategy, we are going to use Nifty Bees because Nifty you cannot purchase. Okay, Nifty is a index. We cannot purchase Nifty. So what we do to have the equivalent of Nifty, we are going to buy and sell the Nifty Bees ETF. So if it is a stock, consider like if you are doing it in a stock like Reliance or Infosys or HDFC Bank. Whenever like you are selling a cash secured put against it, when the option is exercised or assigned at the end of the expiry, either we will get delivery of the stock if you are selling a put, or you will give delivery of the stock if you are selling a call. But Nifty cannot be done like that. So for that, what we are going to use, we are going to use Nifty Bees to emulate the Nifty as a stock. So my name is JR. I am going to take you through the entire strategy session for the next 30 minutes. Let's start. What we will learn from this session. So first we will see the brief introduction to the Nifty Bees. So there are many newcomers in the market. They don't know what is called Nifty Bees. So I'll give a brief introduction of Nifty Bees. Then we will see the Nifty wheel strategy, what we are going to do. And we will see how the wheel turns every week. And we will see one example trade. And we will see at the end the wheel diagram just as an overview. And then I'll just take you through some key takeaways for this session. Okay. So brief introduction to Nifty Bees. So Nifty Bees is an exchange traded fund which tracks the Nifty 50 index. It simply emulates the index with the same weightage. Like the Nifty 50 stocks, how many stocks are there in Nifty 50? There are 50 companies. It may be 50 or 51, 52 stocks, but it is an index of 50 companies. And each stock has a weightage based on the free float of the capital of the stock. Means if you want to know what is a free float capitalization and all those stuff, you can refer to Investopedia, or you can refer to any of our other YouTube videos in the Nifty BN channel. So I will not go into that subject, but you can consider that each stock's weightage is determined by the free float shares, number of shares, capitalization. Okay. So right now the largest capitalization and the weightage is there for the Reliance stock. Then comes TCS, then comes HDFC Bank. Like that means you can refer to money control for the total capitalization and individual capitalization or weightage of the index stocks. Okay. So what the Nifty Bees does is the Nifty Bees has the same weightage as the Nifty 50 index. So how much the Nifty moves, similar point or the similar amount or similar percentage, the Nifty Bees will also move. So basically it emulates the Nifty 50 index and it tracks it. Okay. So this ETF is run by Nippon Asset Management, and these units, what we call as exchange traded fund units, are listed in the stock exchange BSE as well as NSE with a ticker symbol Nifty Bees. If you want to go and buy or you want to add it to your watch list, just type Nifty Bees. You will get that. Okay. So one Nifty Bees unit, we don't call it as a share because ETF is always a unit. Okay, like a mutual fund. So ETF is, it's a fund means you will say units. If it is a stock, we will say shares. So one Nifty Bees unit is equal to 1/100th of Nifty 50 index. Okay, so today consider that it is 17,400 of Nifty, means the Nifty Bees 1 unit will be roughly equal to 174, means which is 1/100th of 17,400. Okay. There is a minor tracking error because the stock or the Nifty will move, the weightage will keep on changing. For every tick, the weightage will change slightly. So the Nifty Bees will track the index as close as possible, but it is with a minor tracking error, means very, very minute level. So not a major thing, means where we have to account for that. So this is as good as like for any index base index tracking fund. This is there. Even you take an index fund, index mutual fund, there is a minor tracking error. So in the Nifty Bees also there is a minor tracking error. Okay. So the price of Nifty Bees, what I told in the previous point, so 174 for 17,000. But the price of Nifty Bees is slightly higher than the Nifty Spot. Now if you go and see, the price is somewhere about 187 rupees or something. Okay, but the index is at 17,400, but Nifty Bees is at 187 rupees. It is like around 13 rupees more than the Nifty index. Why? Because Nifty Bees are always inclusive of dividends. Consider you buy stock, Nifty 50 stock, you will buy all the 50 companies as per the weightage in your portfolio, you buy and keep it. Then throughout the year, all these 50 companies, one way or the other, they will keep on providing some dividends, right? So those dividends are not included in the Nifty index. It is basically on the share price. The dividend will come to your bank account. Okay. But when Nifty Bees is there, they will be getting the dividend, right? Because they will be holding the shares of all these companies according to the weightage. So they will be getting the dividend. So that dividend is basically added back to the Nifty B unit. One unit price, they will keep on adding the dividend. That is why the price of the Nifty Bees is slightly higher than the level of the index. Okay. So Nifty Bees along with Bank Bees. Nifty Bees is for Nifty 50 index. Bank Bees are for Bank Nifty index. Okay. These are some of the most liquid stocks or units traded in the Indian stock exchanges. Normally, like if you see, there are some illiquid ETFs also. Like you go and see the Junior Bees or ICICI Nifty ETF. All those are very illiquid, especially Junior Bees and ICICI. What I am having it in my portfolio, that is why I know what is the liquidity. They are very poor liquidity. But Nifty Bees and the Bank Bees are one of the most liquid ETFs traded in the Indian stock exchange. The volumes are in millions, okay, every day. So how do we calculate Nifty Bees equivalent to one F&O lot size for Nifty? I'll come back why one F&O lot size in the coming section. But you can see that Nifty right now the lot size is 50, okay, and the Nifty's current value is 17,400. So this you keep it in mind. So the current spot is 17,400 multiplied by the Nifty lot size divided by price of one unit of Nifty Bees. That should provide you the quantity of Nifty Bees you need for equivalent to one F&O lot size of Nifty. Okay. So what happens? I have just made the formula. I just plugged in the value 17,400 multiplied by 50 divided by current Nifty Bees unit price is 187. So that works out to be 4,652 units. So roughly, so it is 4,650 units just for a round number. If you buy 4,650 units of Nifty Bees, it is as good as holding one F&O lot size of Nifty. Okay. You go and buy a Nifty future, it is equivalent to like having 4,650 units of Nifty Bees also. Okay. Let's now you understood what is Nifty Bees and how you can hold a one F&O lot of Nifty equivalent of Nifty Bees 4650. So this number you keep it in mind. This number does not change much because when the Nifty moves up, the Nifty Bees will also move up. When this amount will change, the quantity will change is when the Nifty lot size changes. So till that time, this number does not change. 4650, you can keep it in mind. Okay. So the Nifty wheel strategy is basically a standard wheel strategy done with Nifty options. Since Nifty is cash settled, we are not getting any physical delivery or giving delivery. Okay, all the Nifty options are cash settled. We will be using Nifty Bees ETF to emulate the stock. Okay, we consider Nifty as a stock, so the stock units are Nifty Bees. So consider like that. Okay. So just a refresher on the wheel strategy for the new people who are doing or who are hearing the wheel for the first time. So I'll just quickly explain what is the wheel strategy. So wheel is a 4 steps trade. Okay. So step 1, we sell a put. We say cash secured because you have to keep the equivalent amount of money in cash if you are going to get the Nifty Bees units. Okay, so 1 lot 50 quantity we are going to sell on Nifty and collect the premium. Okay, all the numbers, the levels, I'll come in the coming slides. Okay, now just for you to understand, the step 1 is selling a cash secured put. Cash secured put means you are keeping cash in your trading account to take delivery of 1 lot of Nifty Bees. Okay, step 2, if the Nifty expires below the put strike price, you close the put, means you are booking loss in the put, because if the market goes down and closes below your strike price, your put is in the money. Since it is cash settled, you can always like leave it for settlement and you are booking a loss because your selling price will be lesser, but if it goes down you will be paying more money back. Okay, once you are closing the put in loss, go and buy Nifty Bees 4650 quantity. Means this is as good as you are getting assigned on the stock. Okay. This is step 2. If the Nifty expires above your put strike, means your put expires out of the money, you just keep the entire premium, go and sell another put for the next week. Okay. Step 3. If you buy the Nifty Bees unit 4650 unit in the step 2, then go and sell at the money or out of the money call 1 lot. Means your put is now gone, but you have got a 4650 quantity of Nifty Bees, which is as good as having a 1 lot F&O lot equivalent of Nifty Bees units. Against that, you are going and selling a call option. Okay. Then we come to the step 4. If the Nifty expires above the call strike price, means the market has gone up and your call has expired in the money, then close the call in the loss. Then sell the Nifty Bees, whatever you are having the Nifty Bees, you can sell for a higher price, because when the market goes up, the Nifty Bees will also go up. Equal amount, the Nifty Bees will also go up. And you will still keep the premium with you. The premium you are not even returning. Okay, you are booking a loss on the call, you are giving back some premium or a little higher one, you will pay the amount. If the Nifty expires below the call strike, means the market did not move or the market has gone down little bit, so you just keep the entire premium. You are not going to return anything. Just go and sell another call. Means like step 3. Just keep your Nifty Bees units with you. Sell a new call for the next week against those units. Okay. This is what is called a wheel strategy. So how the wheel turns every week, means what happens in every week. This is a strategy I explained. I am going quickly because I want to keep this video short. So how the wheel turns every week. Suppose Nifty is at 17,400 today. On this day of recording, Nifty is at around 17,370. So I take the round figure of 17,400. So the wheel setup will be step 1. What is your step 1? You remember, sell the cash secured put. Nifty spot is at 17,400. So you go and sell 1 lot weekly out of the money. 17,400 means you are selling out of the money 17,300 put at around 75 rupees. Okay. So by end of the week, if Nifty expires above 17,300, you just keep the entire premium, which is about 3,750 rupees. Because Nifty lot size is 50, you collected 75 rupees, so 3,750 rupees. You just keep it with you and sell another put 1 strike below the spot. 1 strike means you say 100. Don't sell the 50 strikes. Very illiquid. The price will move like anything. Always sell in the round strikes. 100 strikes is good. Okay. Next week means you will have good liquidity. So just sell the 100 strike, 1 strike below the spot. Like 17,400 means sell 17,300. If it is 17,500 means sell 17,400 like that, okay? If by end of the week, if the Nifty expires below 17,300, like say the Nifty went and closed at 17,200, means your loss on the put is 100 rupees because you sold at 17,300, the market has gone to 17,200. So your loss on the put is 100 rupees, but you are not returning the premium, right? You will still keep the premium with you, but you will give around 25 rupees back, okay? You keep the entire premium and buy Nifty Bees 4,650 quantity. For that, you will require about 8.5 lakhs to acquire at around, when the market goes to 17,200, the price of the Nifty Bees will be 185. Roughly, I am telling you, it is not exactly 185, but it will be around that, because if this goes down by, the market is going down 100 points, means it is going about half a percent. So if you remove from 187, if you remove half a percent, it will become somewhere around 185. Okay, that is what I am putting. The premium value may not, or the unit price may not be the same, but it will be around that. Okay, you will require roughly around 8.5 lakh, and 8.5 lakh is the amount which is required for taking delivery of one lot equivalent of Nifty, because one lot Nifty F&O equivalent lot is costing around 8,60,000 rupees. Okay, then that is what I explained in step 2. So we buy the Nifty 4,650 quantity, and at CMP, whatever is that day closing price towards the close, you can simply go and buy that one. Okay, then the moment you buy it, simply sell the call against it for the next week. So step 3, what we will do, sell one lot of weekly, because now the Nifty spot is at 17,200, just one strike out of the money, 17,300, you can go and sell for 75 rupees. If you go and check the price, it will be somewhere around 75 rupees. You can go and sell it. Okay, here also you will collect around 3,750 premium. Okay, then what happens, again the same, by end of the week, if the Nifty is below 17,300, your call is 17,300 call you sold. If anywhere below 17,300, you just keep the entire premium and then sell another call on Nifty, wherever the spot is there, just sell 100 points away. Okay, round strikes. If the Nifty expires above 17,300, means you sold when the index was at 17,200. So say Nifty went back to 17,400, means how much you lost? You lost 100 points, because you sold at 17,300. Now the Nifty is 17,400. So your call is 100 points in the money, but you have already collected 75 points. Okay, 75 rupees you already collected. So you are going to give back only 25 rupees. So simply keep the entire premium, and you will be booking a minor loss on your call, and go and sell your Nifty Bees, because the market has already gone up. So your Nifty Bees would have gone up. Just sell the Nifty Bees and book the profit. Okay, the amounts I will come in the next slides. We will see how the trade works out. So it is there on that. So that is what I am mentioning on the step 4. So step 4, what we will do, Nifty spot has gone to 17,400. So what we do, we simply sell our 4,650 quantity of Nifty Bees at 187. Now the price has gone back to 187, because the market has gone up by 200 points. So the price has gone up to 187. Our purchase price was 185. Now you have sold it at 187, 2 rupees profit here. Okay. So now the wheel will turn again. Now what you have got, once you sell your Nifty Bees, cash will come back to your account. Okay. Now you are at step 1. You have only cash with you. Now what we will do, we will revert back to step 1. If you followed this, now you must know what is step 1. Step 1 is what? Nifty spot is set 17,400. What we will do in step 1? Yes, sell again one lot of weekly 17,300 put at 75 rupees. This is for the coming week. Okay. So now let's see how the trade performs. Means now I have told you how to do it. So now with the amounts, let us see how the trade performs. Again, it is same. I am keep on telling the step 1, 2, 3, 4, because it is just I want to drive this point through your mind, that you will remember this for a longer time. I will go very quickly. So Nifty is at same example. Nifty 17,400. What you will collect is 3,750 rupees. So case 1. If Nifty closes above 17,300, now you have sold a put. If the market closes above that strike price, your put will expire worthless. So you will keep the 3,750 and sell another put for next week expiry. Just one strike, not even two strikes. You can just sell one strike, because if you sell one strike out of the money, it is almost at the money. You will be collecting a higher premium. Okay. Here your gain is 3,750 rupees. Okay. Okay. Let's see case 2. If the Nifty closes below 17,300, means say at 17,200, means your put is now in the money. It is expiring in the money. So you have sold 17,300 and it is closing 100 points in the money. So what you can do, keep the 3,750 rupees premium you collected. That nobody is going to take away from you. Once you collect the premium is yours. Okay. Now close the put. You are closing 100 points in the money, means your loss is 5,000 rupees. 1 point is 50 rupees, so 100 point is 5,000 rupees. But net, how much you are losing? Since you have already collected 3,750, you are losing only 25 points. You collected 75 points. You are losing only 25 points. That is equivalent to 1,250 rupees. So this is the net loss for you when you close the put. And at the same time, what we will do, we will close the put and we will buy the 4,650 quantity of Nifty Bees at 185, because since the market has gone down, you will be buying the Nifty Bees at the little lower price. For this, as I said in the previous section, the capital required is little more than 8.5 lakhs. Okay. Once you buy the Nifty Bees, the step 3, immediately what we are going to do, we are going to sell one lot of weekly. Now the market is at 17,200. So we will go and sell the next week weekly 17,300 option for 75 rupees. Just one strike out of the money you can go and sell. Here again you will collect 3,750 rupees. Okay. So again same case. Now right now what you have? You have 4,650 quantity of Nifty Bees with you at 185 rupees, and you have a open call sell position at 17,300 for 75 rupees. In case by end of the week, when the Nifty expires, weekly expiry happens, if it closes below 17,300, you simply keep the premium because your call has expired out of the money, and you just keep the premium and sell another call for the next week expiry, same 1 or 2 strikes above the spot. If it is expiring at about 17,250 or 17,200, just 1 or 2 strikes above the spot, means you can again sell 17,300. Okay. Case 2, if Nifty closes above 17,300, your call will be in the money. Say it closes at 17,400 again, your call is 100 points in the money. You collected 75 points. So you will still keep all the premium with you and you will close the call in the loss. Loss of 5,000 rupees. Since you collected 3,750, your net loss is only 1,250 rupees. Here what we will do, we will do a additional step. Step 4. Once you are closing the call in loss, you will be selling your Nifty Bees, whatever quantity you are holding, 4,650 quantity at 187, because the market has gone up. It closed at 17,400. When you purchased it when it was 17,200. So you are going to sell it at 17,400. Obviously, the Nifty Bees price would have gone up. Here you will have a profit of about 9,300 rupees. Okay. So what is your net profit and loss for this step 3? What is your net profit and loss? You have 9,300 rupees which you have profited in Nifty Bees, and you booked 1,250 rupees on the call. So your net profit is about 8,000 rupees. If you reduce the brokerage, so it will be about 8,050 rupees. If you reduce it, it will be around 8,000 rupees. So this 8,000 rupees is very close to 1% of your initial capital. Your initial capital is about 8.5 lakhs. So you are getting around 8,000 rupees. So the premiums will be here and there. You will be getting very close to 1% or 1% of the your capital every week. Okay. If you are doing for every week, and if you are profitable 80% of the time, you will be getting somewhere about 40 to 45% on your capital deployed per annum. 40 to 45%. Only some mutual funds also do not give. Mutual fund, your average annual return is somewhere about 15 to 16% only. Stocks will be about 18%. So this one is 40 to 45% you can get. Okay. Now, once you have closed the step 4, right now what you have got only cash. You don't have any option position open. You don't have Nifty Bees. You have got only cash. Means you are again at step 1. So step 1, what we do? We go and sell a cash secured put. 1 or 2 strikes below the spot. Okay. So that is how the wheel turns again. We just start again from the step 1. Okay. Let us see how the wheel diagram will look like. So I'll just summarize what we have discussed for last 20 minutes. So the wheel, first step, what we do, we sell a put, we collect a premium. Okay. Then what happens? The put becomes ITM. We will book loss in the put, but we will still keep whatever premium is collected. The net is only loss. Okay. Then once you are closing the put in the loss, you go and buy Nifty Bees, you will pay capital for that. Okay. Then parallelly, we will sell a call and then collect premium for that. If the call becomes ITM, we will book some minor loss in the call, but we will still keep the whatever is the premium collected. We sell the Nifty Bees and the capital will come back to us. Whatever capital we used for buying the Nifty Bees, since the call is ITM, the Nifty Bees will be in profit. So we sell at a higher price and your capital will increase. Okay. You kept the premium, you keep the capital, and the loss, whatever you are booking in the call, will be less than this two. Okay. Then what we will do? We will go back and again sell the put. This wheel will keep on turning every week. If the put is expiring OTM, we don't go to the next step. We again go back and sell a put. Here again the same. Once you are selling a call and if the call expires OTM, then we don't go to the next step. We will be again selling the call. Okay. So I hope you have understood the wheel concept. So I'll just give you some takeaways for this. When you are selling a put for the first time, you don't have to keep any extra cash with you because you already have a huge amount of cash to buy the Nifty Bees. You have got about 8.5 lakhs to buy the Nifty Bees. So you don't need any additional cash for step 1. Your initial will work. And once you are closing the put, you will be closing in some minor loss only. You will be keeping the premium. And once you close the put, you can go and buy Nifty Bees with the same capital what you have, because once you close the put, your your margin will get released and you can go and buy the Nifty Bees. Once you buy the Nifty Bees, to sell this call, you will require around 80 to 90,000 rupees extra. So when you have 8.5 lakhs, better to keep around 9.5 lakhs with you so that you can go and sell a call, because our DMAT and F&O are not linked normally. It will get, the link will come only on the expiry. It will not come before that one. Since the Nifty is cash settled, you do not have a huge delivery margin increase in the Nifty options. Okay, in the stock options, it will come every month. Every month in the last week, the last 4 days. Consider Monday, Tuesday, Wednesday, Thursday, or for the monthly expiry, you will have the delivery margin requirement coming in. So that will not be applicable for the Nifty or the index options. Okay, so you will require about 90,000 rupees. For the stock, you will require about 6 to 7 lakh rupees. Means you have to keep it separately along with the your capital, whatever you purchase that unit. On top of that, you have to keep more money. Okay, but here you don't require that. Once your call, you are closing and you are selling the Nifty Bees, then again when you come to step 1, you don't need any additional capital. You can simply use your existing capital to sell the put. That is much more than enough, because you will require about 1 lakh rupees to sell it, but you already have about 8.5 lakhs with you. Okay, and this one, how it is getting different from the stock option is, stock option you can do only monthly. Stocks are not weekly expiry. Stocks are only monthly expiry. In the stocks, you will get a much richer premium. Okay, if you go and sell any Reliance call option or Reliance put option or Infosys call or put option, the returns or the premium what you are receiving will be quite high, because it is only monthly expiry and the underlying has a delivery margin requirement in the last 3-4 days of the expiry. Okay, so the Nifty one, it will expire every week. So every week you are not going to hold this trade for a longer time. You are going to hold this trade for 5 days only. So for 5 days, if you are collecting somewhere close to 0.8 to 1% of your capital deployed, this is good. In the monthly, you will be holding it for a long time. If the stock is coming up with earnings, that month we will not be able to do this, because the stock may go up or it may tank down. So that time you will have, either you are having a cash secured put. If the stock goes down, you have to take delivery at a much lower price. Okay, you will be taking delivery at a higher price, but the stock will be in a lower price. In the stock, the loss what you are booking here, that will be your MTM in the stock. Okay, like for example, if you are selling Reliance 2400 put option, that is out of the money, just at the money put option if you are selling, and tomorrow or by this month end, if Reliance comes down to 2300, your put will become in the money. You don't have to close the put, because you will be taking delivery of Reliance stock, but you will be taking delivery of Reliance stock at 2400. But where is the Reliance price? Reliance price will be 2300. So the loss of 100 rupees where we are booking here, that booking we cannot do in the stock option. So that will be a MTM. So you have to wait for the Reliance stock to come up to clear that MTM. But here every week you will be booking the loss or you will be booking the profit straight away. Okay, and this is every week. The stock, it will be every month. And again, in this, what I am trying to stress is, never sell a call option below your purchase price. Because here, if you say Nifty Bees, you have acquired Nifty Bees at 17,350. Consider like that. You have acquired, you have sold 17,400 put option and you have acquired the Nifty Bees at 17,350. Never sell anything below 17,350. Call option never sell below 17,350. If you are selling, you will be making loss in your underlying, because when you have to deliver, you will be delivering in a lesser price than your purchase price. Okay, always sell 17,400, 17,450, 17,500, like those options you can sell. And you have to always keep track at what index level you are acquiring your underlying. Here the underlying is Nifty Bees. So that Nifty Bees, if you are trying to deliver, you should be delivering at a higher price. You say 17,350 is the place where you acquired Nifty Bees. If you are going to deliver your Nifty Bees at 17,300, obviously you will be delivering it in a loss only. Okay, so never do that. Always sell your call option above your acquisition price. Never sell below that one. 17,350 if you are acquiring, always sell 17,400 and above call options only. Even the premium you are collecting less, it is okay. The market will eventually recover and you will be making money on a long term. 1 or 2 weeks, if you are collecting lesser premium, it is perfectly all right. And here you have a lesser risk. I never say no risk, but you have a lesser risk, because normally in a longer run, the index goes up. I cannot say this about an individual stock, but on a longer run, the index will go up. So it is pretty safe to do the strategy on the index rather than doing it in a stock. The stocks will give a very good return. You will get a very good premium on the stock, but you need to keep a lot of cash. You need to keep almost like double the money what you require for selling index options. Okay, because stock option, the premium, the margin money is little higher. Like if you are going and selling, I'll take a different example. ICICI Bank, if you are going to sell 800 call option, you will require somewhere about 1 lakh. Okay, the same thing if you are selling Nifty options, you don't require 1 lakh. You will be requiring at least 30,000 rupees less than that. 75,000 to 80,000 rupees you can sell one index option. And that index option does not have the delivery margin requirement. ICICI Bank, if for this month expiry, in the last week of expiry, from Monday onwards, you need to keep the some percentage of the money to buy or take delivery or give delivery of the ICICI Bank shares. Means ICICI Bank, one lot will be somewhere equivalent to 6.5, 7 lakhs. Okay. So for on Tuesday morning, you should at least have 2 to 3 lakhs in your account cash, in addition to holding the underlying, because it is not linked. But in index options, that issue is not there. Okay. So that is one advantage of it. So I have given you the advantages and the disadvantages. Disadvantages means you have to keep track of which level of the index you are acquiring the Nifty Bees, and never sell any option, call option below that level. That is what I am wanting to stress, because if you are selling below that, and if the stock, if the option becomes in the money, you will be going and selling your Nifty Bees at a lower price than what you purchased. Always sell the Nifty Bees for the higher price, because the Nifty Bees you will be booking only profit. In the call and put, you may book loss as well as profit, but always if you see in the Nifty Bees, you will be booking profit only. Okay, the underlying, never sell it in loss. So that's it for this session. The same thing we can do it in bank Bees also, so I don't want to confuse with these two. So this one I have already suggested, Nifty Bees. In Nifty Bees there is another way of doing it. I'll be coming up with another video. Instead of doing a weekly options, we can do it in half yearly options. Means you don't have to worry about every week how it is going. So you can sell July options or June, end of June options you can sell, and you can sell December options. You will hold your Nifty Bees, you can keep it with you and go and sell December options. Right now you can go and sell end of June 2022 options you can sell, or you can sell 2022 December options also. That is not available in bank Nifty, that is not available in stock, that is available only in Nifty. For that I'll come with another strategy video how to do that. I have to see the premium levels. Once I fix those premium levels, I'll get back with a different strategy. So that's all for now. Thank you very much for being with me for about 40 to 45 minutes on this strategy. May the markets be with you. This is JR signing off. Take care. Bye bye.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab. So do not forget to check that from time to time.